Good morning. Thank you for joining us today. My name is Courtney Yockey, and I'm with the F&M Regional Growth Alliance, and here today representing the Business Navigator Alliance of South Central and Southeastern Illinois. We have an excellent presentation stored for you. Today, we're diving into the topic of C-PACE financing, or commercial property assessed clean energy, if you will. And more specifically, the Illinois Finance Authority's PACE program, or the IFA PACE. CPACE is a tool that can be used to finance energy efficiency and renewable energy improvements. And the IFA PACE program is designed to be a vehicle for CPACE and to spur investment in energy efficiency, water conservation, and electric charging stations, all the while stimulating growth of renewable energy and resilient business design throughout Illinois. We have Brad Fletcher with us this morning as an expert towards this topic to guide us through today's discussion. Brad is the Vice President and Treasurer of the Illinois Finance Authority. Today, Brad is going to answer the questions of what is CPACE, what is a CPACE program, and how does it work, and what is the IFA PACE program? Before we get started, first of all, what is the Business Navigator Alliance of South Central and Southeastern Illinois? Well, we are a 6-county regional collaboration working through the Small Business Community Navigator Grant. Our partners, as you see over to the right of your screen, is Angela Griffin with Coals Together, Lori Miner with the Sullivan, Illinois Chamber and Economic Development, Risa Shaner with the Crawford County Development Association, Norris Wallace with the Marshall Area Chamber of Commerce, Bob Colvin and Freddie Schmitty with the Paris Economic Development Corporation, and then myself, Courtney Yockey, with the F&M Regional Growth Alliance. This group is charged with professional outreach and technical assistance for local, state, and federal programs. Our mission is to ensure that small businesses in our region are competitive in applying for necessary resources, and our goal is to position you for success by accelerating business recovery and growth. As you'll see to the map on the side of your screen, this is where the Business Navigator Alliance is located. Today's webinar is part of a series of business webinars that we're hosting each month. These webinars are typically scheduled for the last Thursday each month, so please mark your calendar. The exception for this one today, we're a week early to try to avoid conflict that anybody may have with the 4th of July holiday coming up and the weekend prior to the 4th of July holiday. So do visit businessnavigators.com. That's navigators with an S, and sign up for our newsletter to stay informed. In addition to these webinars, we also host various outreach events, office hours, and offer one-on-one technical assistance. Again, visit businessnavigators.com to learn more. We'll post a recording from today's presentation and additional supportive materials on the website as well. And then at the conclusion of today's webinar, you should receive a short 5-question survey. We hope that you complete that survey. We'd love to hear your feedback on making improvements to these webinars and on future topics. I would like to note that if you do have any questions for the Business Navigator Alliance or for Brad throughout this presentation, please put your questions in the chat. And then would like to remind you that there will be a follow-up email for those that did register to this webinar. Will be sent out, the link to the recording will be sent out next week. So to get us started, Brad Fletcher is the Vice President and Treasurer of the IFA. Since 2010, Brad has managed traditional tax-exempt project financings from application to closing, effectively leading commercial and industrial, higher education and nonprofit, and local government borrowers and their respective banks or underwriters to successful conduit debt issuance outcomes. As a strategic and efficient public finance professional, Brad developed and implemented the nonpartisan, non-political Illinois Finance Authority PACE program to accelerate private investment in PACE projects in any county, city, village, or unincorporated town throughout Illinois. The IFA PACE program makes commercial property assessed clean energy, CPACE, financing available for owners and developers of commercial properties at no cost to the county or municipality establishing the program. The IFA PACE program is administered by a component unit of the Illinois Finance Authority known as the CPACE Open Market Initiative, which is a 501c3 organization. The goals of the CPACE Open Market Initiative are to spur investment in energy efficiency and water conservation, and to stimulate growth of renewable energy and resilient business design throughout Illinois. Brad regularly discusses PACE projects, opportunities and best practices with industry stakeholders and economic development officials of local governments to ensure Illinois is a national leader in the CPACE financing market. Since November of 2019, IFA has issued bonds or notes in the aggregate principal amount of approximately $75.75 million to finance qualified PACE projects under Brad's leadership without relying on any appropriation of taxpayer or ratepayer dollars to support the state agency's mission or operations. Quite impressive, Brad. Brad has earned his undergraduate degree in public policy study from DePaul University and has a master's in business administration and finance from St. Xavier University. Brad, are you prepared to present, sir?
Yes, sir. Well, thank you so much, Courtney, for the warm introduction. Thank you for the Alliance for having me today, and thank you for the 30 or so participants that took time out of your morning today to learn about a new economic development finance product that is available to local governments in Illinois. At the risk of being somewhat unconventional today, I do not have a PowerPoint slide to walk through. Rather, what Courtney and I envisioned was more of an informal discussion, and I will walk through my website, ifapace.com. Courtney just put it in the chat, but also share my screen as I walk through the website. I somewhat break up this conversation to three parts. One, just making sure everyone understands what the Illinois Finance Authority is and is not. Secondly, I walk through what a PACE project is, since this is new to all of us. And then lastly and thirdly, I walk through what the IFA PACE program is and what the benefits are to local governments. Courtney, with your permission, I'll share my screen. Thank you. So today we're discussing property assessed clean energy. This comes to us by way of the Property Assessed Clean Energy Act, 50 ILCS 50. This statute was originally enabled in 2017, but it was not until IFA and various law firms got a chance to rewrite the statute in 2019 that it became enforceable and actually actionable. Prior to that, it was somewhat dead on arrival due to poor drafting. But we are happy to say that the governor has signed this law into the books and records of the state of Illinois. And furthermore, if I may brag for a second, I'm very happy to report to all the attendees on this webinar today that the technical rewrite of the Property Assessed Clean Energy Act received unanimous approval both in the House and the Senate, which is very rare for any piece of legislation, especially one that can be drive the needle on climate change, as well as save operating costs for commercial property owners throughout the state. So this next tab here, this is ifapace.com. This is the Illinois Finance Authority's website. This particular page is dedicated to the Property Assessed Clean Energy Program. To understand the PACE program, we first need to understand what the Illinois Finance Authority is. The Illinois Finance Authority is a body politic and corporate of the state of Illinois. So we were created in January 2004. We are an amalgamation of predecessor agencies. Perhaps some of you are familiar with the Illinois Development Finance Authority, the Illinois Health Facilities Authority, the Illinois Rural Bond Bank. 7 predecessor authorities were consolidated and amalgamated into the Illinois Finance Authority. And so despite only being created in January 2004, our staff and our staff expertise goes back approximately 4 decades. And our main role at the Illinois Finance Authority is to assist in economic development finance throughout the state. We are a statewide agency, we are not regional. And because of that, we offer certain benefits to certain types of property owners, such as healthcare institutions, higher education institutions, and developers who have projects in multiple jurisdictions throughout the state. IFA is a self-funded agency. So you'll recognize that our website ends in .com, not .illinois.gov. Another way of saying it is we are very motivated to close financings throughout the state because we pay our own bills. So we do not receive taxpayer appropriations, we do not receive ratepayer appropriations. Somewhat similar to a bank, the only money that we generate is the money that our staff generates, the revenue the staff generates through project closings. So we are a self-funded agency. We are tasked with conduit finance. And conduit finance, as a general rule, is the public financing by the authority for private projects. So these are projects undertaken by private lenders and private borrowers. We are simply a conduit between two private actors. And that's what PACE is. And so this is a really good time to jump into what a PACE project is, so we all have the same baseline. So stepping back to our website, I'll walk everybody through a few attachments so everybody can review these later. But firstly, I'm going to go to the bottom of the website here, the website text, and I'm going to somewhat walk through this paragraph here briefly about PACE projects. So what are PACE projects? PACE projects are any projects undertaken by existing buildings and property owners that are intended to conserve energy, promote renewable energy, offer resiliency. Resiliency somewhat tends to surround building envelope type improvements, such as roofing tiles, better insulated windows and the like, as well as more durable concrete, things of that nature, as well as improvements that are intended to conserve water. Furthermore, electric vehicle charging stations are eligible improvements too. So the scope of CPACE financing is limited to these particular attributes, but please understand that when people install energy efficiency measures, renewable energy measures, resiliency measures, water use measures, and the like, what they are attempting to do is lower their operating costs, reduce their energy load, if you will, and reduce their utility expenses. So it's a win-win for commercial property owners, as well as public policy promoters of climate change improvements. So given this scope, what type of properties, what type of assets can be eligible for CPACE financing? And we have it right here. It's for privately owned commercial, industrial, non-residential, agricultural, or multifamily properties, or any property owned by a not-for-profit entity. So you'll note here that this is not for government-owned buildings. This is for private sector-owned buildings. More often than not, we can use the standard commercial eligibility, but for multifamily properties, these are limited to 5 or more units or more. So your typical 3-flat with a garden apartment with 4 apartments within the property would not qualify. The statute limits CPACE financing eligibility to multifamily units of 5 or more. So that's important to remember when looking out at the economic development landscape as far as eligibility for CPACE financing and what lenders are eligible to finance. CPACE financing is a really great way for existing buildings that are outdated in new construction to finance these type of improvements on a more affordable basis. Typically, commercial real estate is financed through mortgage financing, something we're all familiar with, something that all of our local county recorder offices are familiar with. In that way, CPACE is very similar. There's a private borrower, there's a private lender, and the assessment contract, similar to a mortgage, is simply recorded as a lien with the Cook County, with the county recorder. That is to say that the local assessor and the local treasurer need not spread the assessment for any particular financing, and furthermore, need not bill and collect. Just like Courtney and I receive our mortgages in the mail once a month from our mortgage lenders, property owners will receive their bills for their CPACE financings from their lenders semi-annually or quarterly, or subject to negotiation on a different timeline. So now that we understand what a PACE project is, it's eligible improvements tied to a commercial property, we can somewhat walk through what the Illinois Finance Authority PACE program is. As Courtney noted in her introduction, this program is nonpartisan and non-political. That's intentional. This is for economic development finance. So neither the authority nor the lenders play political favorites, if you will, here. This is intended to be a through and through economic development financial product. And as Courtney also mentioned earlier, this is available for any county, city, village, or incorporated town throughout Illinois. Incorporated towns are important to note there. There's roughly only about 20 under pre-1870 existing charters, but they are eligible and they were part of the rewrite of the PACE Act in 2019. So under the IFA PACE program, either counties or municipalities can avoid using their own time and resources to issue bonds or notes to fund PACE projects. Somewhat similar to special assessments laws in Illinois, the Illinois Property Assessed Clean Energy Act requires that these projects are financed through the issuance of bonds or notes. But for the Illinois Finance Authority PACE program, each county would be required to issue bonds and notes to fund these projects, and the bonds and notes will be purchased by private lenders. Under the Illinois Finance Authority program, IFA as a state agency issues the conduit debt such that the counties and municipalities that establish the IFA PACE program do not need to issue such debt. And because they're not issuing such debt, there's no accounting or related conduit debt compliance that goes with the financing of these projects. Again, this is a very hyper-local economic development product. This product and program is established by local governments. There are 1,295 municipalities in the state of Illinois, and there are 102 counties. So what the IFA is offering here is a statewide conduit issuer, is offering standardization for the market, both for lenders, so they have a turnkey solution to funding these projects throughout the state, and also for developers and commercial property owners that have multiple eligible properties in multiple local governmental jurisdictions. And that standardization improves the flow of capital to Illinois. And as Courtney noted, to date, IFA has financed approximately $80 million of conduit debt for such PACE projects throughout the state. In the right side margin of our website, we have case studies of projects that have been financed to date. I'll click on that link here, and I'll just walk through one brief project. The project I will walk through was in Beardstown, Illinois, in Cass County. And this was for the Swift Pork Company. Swift Pork Company has a pork processing plant in Beardstown. And Swift Pork Company wanted to install some solar panels on their facility, and they wanted to do that with the security of a special assessment through a CPACE financing, rather than doing it through a mortgage financing. The city of Beardstown established the program. The city of Beardstown signed the assessment contract as negotiated between Swift Pork Company and their preferred lender. And the city of Beardstown then assigned that assessment contract to IFA, my agency, a state agency, for the financing. My agency issued conduit debt, which was purchased by Counterpoint Sustainable Real Estate, which is a large lender in the CPACE marketing space. This particular project was approximately $4.5 million. And you can see here in this summary report the amount of savings that Swift Pork Company was able to achieve on an annual basis, not over the life of the loan, but rather just on an annual basis. And that's a lot. And you can see on an annual basis, through undertaking this financing, they're able to save approximately $222,000 a year. And that's the double bottom line benefit for CPACE financing for commercial property owners in each of our backyards. This type of financing offers long-term fixed interest rate financing, not otherwise available through conventional means. What does that mean? Here you see the interest rate for this particular project was fixed at 5.2%. Notably, the maturity is longer than 7 or 10 years. Our typical banking partners throughout the state of Illinois and throughout the country typically offer terms of 10 years or less, and that's to their best customers. PACE financing is an institutional financial product, somewhat more analogous to commercial mortgage-backed securities. It's non-recourse, and it's for long-term financing. You can see here the term of this financing goes out to 2035. That would not be available in the conventional real estate finance market. That is the benefit for CPACE. It allows for a longer runway so property owners can fix their interest rate, undertake a cost-benefit analysis, and get comfort that this savings will be realized throughout the life of the loan. Going back to the website, we have several marketing documents available for your perusal, and I'll quickly step through a few of these to develop a basic understanding of the program design as well as the financing process. This document here is called Program Design, and you can see the parties that are a part of any particular PACE financing. There are local governments. Again, that can be any county, city, village, or incorporated town. There's the Illinois Finance Authority here in the center. We are a statewide agency, self-funded, and we are the ones that undertake the financing of these projects, not the local governments, which is important. Again, going back to my earlier comment, you can imagine if there were 1,400 different forms of this program throughout the state of Illinois, they would be very expensive for each local government to develop, and it would be very unwieldy and expensive for the lenders and property owners to come to terms with. And what we've done here at the Illinois Finance Authority to standardize the market is we created our own not-for-profit entity. The question is always asked, why did Illinois Finance Authority, a state agency, create a not-for-profit called the CPACE Open Market Initiative? And there's a very simple answer for that. If we go back to the Property Assessed Clean Energy Act, definition of program administrator is a for-profit entity or a not-for-profit entity. Accordingly, the Illinois Finance Authority, a state agency, created a not-for-profit entity to be a program administrator for each local government that establishes the IFA PACE program. The role of the PACE area administrator is to interface with the local governments on a non-exclusive basis as a program administrator for each local government. Furthermore, because the Illinois Finance Authority program is independent and neutral, capital providers are also their own PACE project administrators. That should seem somewhat intuitive. If we think of traditional commercial real estate finance, banks administer their own loans. What the IFA PACE program allows for, therefore, is it allows capital providers, investors, to administer their own loans by being PACE project administrators. The counter argument to this structure is what currently exists in northeastern Illinois. Several counties have engaged one singular capital provider to be the exclusive program administrator for the entire county. As you can imagine, certain conflicts of interest arise under that type of structure. Furthermore, other lenders who have not received such exclusive administrative rights are forced to pay a fee and share business intelligence with that exclusive program administrator. As a result, the Illinois Finance Authority created the IFA PACE program to level the playing field for all capital providers in the market and incentivize private capital to come into our communities and improve outdated structures, as well as provide more affordable financing for new construction. That is the role of the Illinois Finance Authority PACE program. Going back to our website, I'll walk through the financing process so there's a clear understanding of what this program does and what obligations it imports upon local governments. So step one of any CPACE financing process, assuming the county or municipalities adopted the PACE ordinance provided by IFA, is if a record owner and capital provider have executed a term sheet or intend to execute a term sheet, the capital provider will apply to IFA as a state agency for such financing. Importantly, in step one, they are not applying to the local government. So the Illinois Finance Authority PACE program does not create an obligation for any local government to provide staff or resources to run the day-to-day operations of the PACE program. Those obligations are borne upon myself and my agency and our various vendors and consultants and attorneys. Step two, if the Illinois Finance Authority is supportive of the project, the Illinois Finance Authority will provide the local government a summary of the PACE project and its estimated annual impact regarding energy savings, energy utility bill savings, water savings, and water bill savings. We walked through a particular summary. We've discussed the Beardstown case study, so you understand what these summaries look like. They're very brief, and that's intentional. We strip away the dressing of what a CPACE financing looks like so it can be understood at a very efficient level. After approval by the Illinois Finance Authority and providing of the summary to the local government will also receive a compliance certificate from the capital provider for the PACE project. That compliance certificate will certify as to the requirements that are required by the Property Assessed Clean Energy Act, which if you print it out on 8.5 by 11 paper, is about 11 pages long. So the PACE Act in Illinois is quite prescriptive, and that's intentional. We wanted a very prescriptive statute so that everyone's playing by the same rules and so that everyone understands the rules of a PACE program, whether it's the Illinois Finance Authority PACE program or a private operated program. So once the local government receives a compliance certificate and receives a summary from IFA stating that the IFA has approved the project, it's only at the satisfaction of a local government that the project can move forward. Why is that? When we technically rewrote the Property Assessed Clean Energy Act, we left it the prerogatives of the local governments in the statute. What does that mean? That means that only a special assessment can be imposed by a local government, either a county or municipality. A special assessment cannot be imposed by the Illinois Finance Authority, the state agency. So for any prospective PACE financing, there is a collaboration between IFA and a local government. First, IFA has to be approving of the project. And secondly, and perhaps more importantly, the local government has to be supportive of the project. If the local government does not execute the assessment contract, nothing happens. That's important to remember when considering adoption of a PACE ordinance. If a local government adopts a PACE ordinance and never signs an assessment contract for a PACE project, nothing ever happens. By adopting the PACE ordinance, each local government is simply enabling a new tool in the economic development toolbox for commercial property owners in each of our backyards. It is for each project a collaboration between IFA and such local government. It's a two-step approval. And that collaboration is intentional such that the local government will always retain its prerogatives for each PACE project. So, as an example, let's say tomorrow Effingham County adopts the PACE ordinance and the related program report. In a few months from now, a property owner executes a term sheet with a capital provider. IFA is supportive of the project, provides a summary to the local government, Effingham County in this case, and Effingham County receives a compliance certificate from the lender. It is only at the satisfaction of Effingham County by signing the assessment contract that the project can proceed. Let's think about why. IFA is undertaking the financing, not Effingham County, but IFA cannot finance anything without collateral. Somewhat similar to a mortgage, the assessment contract and the assignment thereof is the collateral for the financing. So if Effingham County does not sign the assessment contract, nothing happens, full stop. On a related note, the form of the body of the assessment contract and the form of the assignment agreement are standardized, will not be subject to change. Just by way of example, going back to the bottom of the IFA website, you'll find here the IFA PACE program report and the aforementioned enabling ordinance. Clicking on the program report as a PDF, you'll note there are two appendices. The first is the assessment contract, which is roughly 25 pages long. This document is the same for each and every PACE financing. This document has been thoroughly vetted by multiple local governments, both counties and municipalities, as well as lenders, as well as attorneys of the authority. This document is very prescriptive, and this document intentionally does not change from one project to the next. Accordingly, that lowers the legal and financing costs of each prospective PACE project. What does change for each project is Exhibit A. Exhibit A is where we find the name of the particular property owner, description of the property, a description of the project, and furthermore, and perhaps more importantly, the terms of the financing, the proposed closing date, proposed interest rate, proposed term, prepayment terms, redemption terms, and the like. And what we'll see is, in an actual assessment contract, this table will be built out. This table is negotiated between the property owner and the lender, and this table provides the levy throughout the life of the loan. You recall I earlier said it will not be the responsibility of the county or municipality to spread the assessment. Rather, that will be negotiated between the property owner and the lender. If they need to consolidate pins or split pins, that will be done according to the regular protocols and procedures of the local county. The second document that is approved through adoption of the enabling ordinance and approval of the program report is an assignment agreement. This is a much shorter document. This document is also standardized for each PACE project. This document assigns the collateral that is executed between the governmental unit and the property owner to the authority so that the authority can undertake the financing. Why is the authority undertaking the financing? So that the counties and municipalities need not issue this conduit debt and be required to comply with the compliance provisions of the financing documents, and furthermore undertake the accounting obligations for the life of these loans. Recall, these loans are intentionally 10 years or longer, and in fact can go out to 40 years under the Illinois Finance Authority Act. That is a long time for accounting and compliance obligations, and that is why the authority has stepped into the breach, if you will, and has tried to standardize the market. IFA has been in this fixed income market for the better part of 40 years. This is something we understand and something we do on a day-to-day basis already. So going back to our website and our financing process, step 4, provided both IFA has approved the project and the local government has approved the project, IFA will issue bonds or notes under a standardized statewide open indenture. Again, IFA is a statewide agency. The lenders in this market want their Big Macs to taste like a Big Mac, whether they're in Beardstown, Illinois, or Chicago, Illinois. IFA offers that standardization. It's the same singular indenture throughout the state, and because of that, cost of financing of these projects is diminished throughout the state, and that's the real win-win for having a standardized program throughout the state of Illinois. But under our program, each local government will always retain its prerogatives. Said another way, financings only go forward if a local government approves of such projects. Comfort is provided in the statute because, again, the statute is very prescriptive. So for each financing or interim financing of a PACE project, they are primarily secured by the assigned assessment contract, as I mentioned earlier. That's the collateral. But as far as comfort, each project will be accompanied by a nationally recognized municipal bond council opinion. Typically, when local governments issue general obligation debt secured by property taxes, such issuances are accompanied by a bond council opinion. Such is the same here. This is conduit debt financing in the fixed income bond market, and accordingly, a bond council opinion is required by state statute. Furthermore, an energy audit is required by the state statute in certain circumstances. Upon issuance of the debt by IFA, again, not by the local government, step 5 is the capital provider selected by the property owner will purchase the bonds or notes issued by IFA, or they will provide any related interim financing. In each case, to fund the acquisition, construction, installation, or modification of the particular PACE project. Step 6, final payment to the contractor or contractors is not authorized until the local government receives a completion certificate from the property owner that the requested PACE project was properly acquired, constructed, installed, or modified, and is operating as intended. That provides additional comfort that the property owner is satisfied with the financing process. In step 7, and perhaps most importantly, the local county treasurer does not need to bill and collect these assessments. Similar to a commercial real estate mortgage, the capital providers will bill and collect these assessments directly with their property owners, or indirectly bill and collect assessments through a third-party servicer. Under no circumstances is the county required to bill and collect these assessments. That also lowers the cost of financing and also reduces the burden that would otherwise be borne upon our local county assessors and county treasurers. So just to give a brief overview of the website, we've already walked through some particular documents. We have some brief website text that provides an outline of the program. As noted here, one of the benefits to the Illinois Finance Authority program is its lower cost. The IFA fee for issuance of conduit debt is 50 basis points. That's a one-time fee at closing. That's half of 1%. And the program most analogous to what Illinois has created here is in California. And for their program, they charge 50% more. So this program, because this is economic development, is a low-cost leader so that we can establish a program throughout the state and move the needle on climate change and reduce operating costs for our commercial property owners. The manufacturer's suggested retail price, I say that in jest, is $150 per PACE project for the local government. That is the suggested fee for the local government. The $150 is intended to cover the shipping costs of an assessment contract and an assignment agreement because bond counsel will eventually need originals of those signatures. If the local government desires to charge $500, $1,000, or more, that is within the prerogative of the local government. $150 is simply a suggested fee. For additional context, I will also add that all financings done by IFA, with the exception of one, the local government has waived their fee because there was not much operational responsibility borne upon the local government other than signing the 2 requested pieces of paper. And that's the win here for each local government in Illinois. IFA undertakes the day-to-day operations of this program, standardizes the financial marketplace for the state, and reduces the administrative burden borne upon local governments in the development of PACE programs, which typically costs more than $1 million each, as well as the day-to-day operations of the program, which require full-time staffing, as well as the accounting and compliance obligations for each loan, which again can be upwards of 40 years. Most importantly, and if there's anything that everybody gets a chance to take away from today's presentation, please remember that no use of public funds is required for the IFA PACE program. This is not public taxpayer dollars. This is not ratepayer appropriated dollars. This is simply private financing between a private lender and a private commercial property owner. The mechanic of a special assessment securing these financings is why we are required to sign the assessment contract and issue conduit debt, somewhat similar to existing special assessment laws within the state of Illinois. Going again through the attachments, the Illinois Finance Authority has a bond program handbook. This can become somewhat nuanced very quickly. This is more for the lenders in the market rather than the local governments or property owners. This is the, in effect, legal document that all parties live by when undertaking and financing with the Illinois Finance Authority. We have a list of approved capital providers. I would caution when reading this list, this is not an exhaustive list. This is simply a list of lenders that have signed up for the Illinois Finance Authority PACE program because they love it so much. This is not a list of lenders that have already funded PACE projects. Some of these lenders have, some of these lenders haven't. And IFA as a state agency is always willing to add additional lenders to our approved list, whether it's a local community bank, a regional bank, or a national bank. Most of these lenders are institutional lenders. They play in the long-term institutional finance space, but you also see we have some national banking associations like JP Morgan, because this is becoming a more, what's the word I'm looking for, commonplace economic development tool throughout the country. At this point in its emerging market, there are roughly 35 states with enabling PACE legislation on their books. And I would say there's roughly a dozen or perhaps 24 states that do this well. And I'm glad to say Illinois is one of the states that does this very well. So again, if there's a local bank that would like to sign up for the PACE program, please have them contact me. Earlier, I put the contact information for myself in the chat, and my contact information is also listed on each marketing document on this website. As you recall, I mentioned earlier, IFA created a not-for-profit entity to qualify as a program administrator. We further received 501c3 designation status from the IRS this past January when we launched the comprehensive Illinois Finance Authority PACE program. We also have a PACE program handbook. Here you can see where there's requirements for each lender to insure local governments. We have minimum scope and limits of insurance. So each local government will be an additional insured on each prospective PACE project. You'll see the fees payable to governmental units in the authority. I'll briefly go to that page. And you'll see the local governments that have signed up for the Illinois Finance Authority program. Again, the IFA PACE program was launched just this past January. We've added a few more local governments since, and in fact, we closed a transaction just last week under the IFA PACE program. IFA as a state agency has been in this market since the statute was rewritten in 2019. We did each financing on a discrete basis prior to January 2023. It was only beginning this year that we launched the comprehensive PACE program for local governments throughout the state, so that each local government did not need to rely upon a private operator receiving exclusive program administrative rights, which gives rise to conflicts of interest. Here you'll see the fees. Again, I mentioned this earlier. IFA's fee for the issuance of conduit debt is 50 basis points. The fee payable to the not-for-profit affiliate, CPACE Open Market Initiative, is $0. It's free of charge. The board of directors of the CPACE Open Market Initiative are the same board of directors of the Illinois Finance Authority. And again, here you see the suggested fee for a local government for signing 2 pieces of paper for each project is $150. Again, that is a suggested fee. If the local government wants to charge a higher fee, they retain that prerogative within the ordinance. Here you'll see that each lender is required to insure each local government and each PACE project. And you'll see the minimum scopes and limits of the insurance. Again, each governmental unit will be an additional insured. And you can see further requirements of the IFA PACE program with respect to insurance. There are underwriting guidelines within the statute. In fact, the statute itself is quite prescriptive in terms of underwriting requirements. Just to name a few, no PACE financing can exceed 25% of property value. That's a very particular number. The reason 25% is prescribed in the statute is because your typical commercial mortgage will be 75% loan to value, which means your typical new construction project is required to come up with 25% financing. They can do that through other means of financing, such as mezzanine financing, which has interest rates in the high teens, or they can dip into their own developer pockets and use their cash. CPACE can finance up to 25% of the value of property. So as you can understand, CPACE and mortgage financing is quite complementary, and in fact can achieve 100% debt financing for any particular statute. So we've also prescribed additional underwriting guidelines above and beyond what is required by the statute. You'll see here that we do not allow for debt to exceed the value of the property when giving consideration to a mortgage. And furthermore, we require that debt service coverage for a mortgage and special assessment, when combined, exceed 1.05 times or more for each project. I mentioned earlier, there are 2 certificates that are provided to each local government that establishes a program for each project. The first is a compliance certificate, and the second is a completion certificate. We noted earlier the completion certificate is signed by the record owner. It states that the record owner is happy with the project and that they would are requesting final payment authorization to their particular contractors. That's an overview of the PACE program. We stepped through program design. That was the smart art that looked like this. And we also walked through the financing process. You remember the Chevron list that was just a few steps. And we also walked through one example of these case studies. There are several here that you can peruse at your leisure. And in fact, we had an additional financing that closed last week. I'll be adding to our website quite soon. Prior to last week, our most recent financings were in Sangamon County with the city of Springfield. And so you get a good feel for what the interest rate environment is for these projects. The typical nominal amount, in my experience, is usually $1 million or more in terms of lender appetite. And typically, we'll find that these projects, again, go out 10 years or longer, whereas conventional real estate mortgage financing is for 10 years or shorter. So with that, I'll stop sharing my screen. I'll turn it back over to Courtney, and I'd be happy to answer any questions.
Awesome job, Brad. My goodness, you're a wealth of information, sir.
Thank you very much.
Oh, yes. Thank you for guiding us in detailing what this program is. Call it a non-traditional form of financing, if you will, and something that is new to a lot of folks. It's a pretty new program all in all. And definitely have had a lot of questions come in towards this, and you kind of answered those questions as you were moving through your project or through your presentation as well. But I mean, first and foremost, thank you for educating us today about the IFA PACE program, about CPACE financing as a whole, and did an excellent job walking us through that and really unraveling a complicated topic, if you will. to get started, do have some questions that came in through the chat, and want to make sure that those get addressed. I did address some of them as you're going through your presentation, but to ensure that they catch the recording here. So you had noted earlier who is eligible for PACE financing, CPACE, if you will. The question did come in that can a 501c3 use PACE financing, and allow you to go ahead and elaborate there.
Yes, in fact, when I rewrote the Property Assessed Clean Energy Act in 2019, that was one of the most important factors that led to the comprehensive technical rewrite. There was some ambiguity in the market whether or not a not-for-profit entity that owned a property could qualify. In fact, we added that to the statute, specifically enumerated in the PACE Act as an eligible property for PACE financing. Whether or not they're a 501c3, it actually doesn't matter. It's whether or not they're a not-for-profit corporation under a state law.
But not a public government, not a public agency, a local form of government.
Right. At the end of the day, what's easiest to remember is if it's owned by government, it doesn't qualify. The rationale there is very simple. You're imposing a special assessment as the security for the financing. The lenders would not be comfortable in a nuclear fallout scenario foreclosing on a special assessment that would otherwise be owned by a local government. Recall, these properties, I guess I'll said another way, the biggest end users of CPACE financing throughout the country, throughout the past decade or so, are hospitality projects. So hotels, as we all know, hotels are always trying to save every penny they can on their energy demand, their energy load. Conserve water. So hotels are very big end users of CPACE financing. So they generate cash. People stay at the room and the building throws off cash. Who operates that hotel is somewhat insignificant. That's the beauty of the special assessment. It's transferable and it provides that comfort for long-term financing. Commercial properties in general, tenants pay rent. Rent throws off cash, so lenders are interested in those type of properties. And the same goes for non-residential agricultural. We had a project in Northwestern Illinois we're working on for a tomato grow operation. So in effect, a 21st century greenhouse. So any type of property that produces income will attract lenders' attention. I mentioned earlier the pork processing plant. It wouldn't necessarily be at the top of mind, but industrial qualifies too. Why? Think of the Swift pork processing plant in Beardstown. Over the past few decades, it's been owned by ADM, Cargill, Oscar Mayer, but through and through, it's always been a pork processing plant. So who actually owns the property is somewhat insignificant from an underwriting perspective.
Gotcha. And I'm going to ask you to elaborate just a little more, but I want to note to everybody we got about 10 minutes towards the hour. We're going to continue this discussion. We've got a lot of great questions that come in. Brad's a wealth of information. We want to dissect this more and digest more of what he has to offer and to continue to educate ourselves. But if you're not able to stay with us, we hope you can join us. You will receive a copy of the link, a copy of the all the supplementary materials. Sorry, got tongue twisted there. Copy of the supplementary materials that Brad went through while he was sharing his screen and during his presentation. You'll get a link to the recording this webinar as well. But Brad, on the topic, just expanding off of what you just noted in that question, can you kind of walk us through that this is transferable? You noted the that is transferable. It can be up to quite an extended amount of time for the term of this, and just really how does that special assessment play a role in this too?
Right. So, starting with traditional commercial real estate loan, right? You have a private lender, you have a private borrower, and more often than not, that lender is secured by a mortgage. In the event the borrower does not pay the mortgage, the lender pursues foreclosure. Same scenario here, but rather than being secured by a mortgage, the lender is secured by a special assessment. Only a county or municipality in Illinois has the legal authorization under Illinois law to impose that voluntarily requested special assessment. Said another way, CPACE financing allows property owners, eligible property owners, to voluntarily request an additional property tax above and beyond what they're being taxed by the local governments. Why would a borrower do that? A borrower would do that to help finance eligible improvements. Those eligible improvements reduce a borrower's operating costs and also have the additional scope of benefiting climate-related activities, if you will. Again, this is why this received bipartisan support, unanimous bipartisan support in the General Assembly. So with the security of a special assessment, the financing is non-recourse to the operator within those four walls of that building. The lien is tied to the property, not the borrower. So let's say a special assessment is imposed at the request of a property owner, and 15 years later, that property owner vacates the property. Another company could come into that building, and the lien would still be on the property, and that next company would pick up the special assessment. And so it's that transferability from one business to the next that allows lenders the comfort to provide long-term financing. Without that transferability, this would be a product that would somewhat not exist, if you will. That's a hallmark of CPACE financing. It allows for transferability from one borrower to the next, which of course leads to the universal question, what happens if somebody wants to sell their property? Well, you can have a private sector solution. The lien can be paid off at the time of sale, or the next property owner could pick up the lien. That's kind of common, practice. In a default scenario, which is where people get concerned because this is a new product, it's treated just like a property tax. There's no acceleration. In Illinois, as we all know, foreclosure proceedings typically take 3 years. So what's important to remember is the mortgage lender will always provide its consent to these financings. The mortgage lender is in effect being primed by an additional property tax. So in a nuclear fallout scenario, there's a foreclosure. The PACE lender will inform the county, the local county, that they have a default, that they need to add the assessment to the foreclosure process, the sheriff sale, scavenger sale, whatever the terminology is at the local level. And in the waterfall, you'll have the county taxes, the fire protection district taxes, the library district taxes, the special assessment taxes, and those will get paid before the mortgage. Mortgage lenders 10 years ago didn't like that scenario because they felt they were being primed. 10 years later, today, mortgage lenders almost always are willing to provide consent because they've come to understand that they have 75% skin in the game, and they are going to have an asset that's improved above and beyond what it otherwise would be by virtue of the CPACE financing. The mortgage accelerates in a foreclosure. So if you have a $100 million project, 75 million of that is a mortgage financing, and 25 million of that is a PACE financing. It's only 3 years of levy that's outstanding in a foreclosure process, whereas the mortgage lender will accelerate all 75 million in foreclosure. And so the idea that the property taxes and 3 years of levy would invalidate the ability of the mortgage lender to recover its cost is untrue. And it's that nuance that I think a lot of people lose sight of. And importantly, more often than not, this is a commercial real estate product. And in this interest rate environment, while it's currently rising, sooner or later it will also lower. And what's important to remember is at any given time, a property owner can refinance a PACE assessment through a second special assessment, which we would then go back to the local government and ask for approval. Or they could simply pay it off, refinance it through a mortgage, or refinance it through another means. Importantly, this is simply a commercial real estate product. It's that mechanic of the special assessment is why we're having this discussion today. And but for that transferability of that lien, we would not be able to achieve long-term financing at a more affordable interest rate than it would otherwise be available.
Thank you for detailing that. I'm really glad that you broke down to what happens in the event of a foreclosure as well. So great explanation. Love asking you questions. You're checking off the questions too as we go. So to continue on, you noted the city and the county are the only two that are eligible to assess this, to assign a special assessment. There was a question in the chat. What about a township as a local unit form of government?
Yeah, so townships wouldn't qualify. They're not legally authorized to impose an assessment. And if I may, you said a county or a city can impose an assessment. It's a county or municipality.
Oh, I'm sorry, county or municipality.
No, it's okay. Yeah, it's important, so I just wanted to reiterate. So either a county or a municipality can impose an assessment. There's three forms of municipalities: cities, villages, or incorporated towns. I think I mentioned earlier, I think there's only about 18 incorporated towns with pre-1870 charters in Illinois, but they are eligible for what it's worth. Township governments are not eligible for this financing. I'll also add on this topic on a related note, I often get the question, what happens if the city of Springfield has established the IFA PACE program and Sangamon County has established the IFA PACE program, for example, which is a likely scenario? Well, the answer is it's an open market architecture. Whoever the property owner and lender prefer to utilize is what IFA will utilize. If the property owner prefers to work with their local mayor, then IFA will work with the local mayor. If the property owner and lender prefer to work with the county chair, then IFA will work with the local county chair. It's somewhat immaterial to us. Again, IFA is undertaking the financing. We've standardized the protocols and procedures. So, bottom line, the property owners will always gravitate to who is reliable, who executes documents in a timely fashion. Obviously, I go out of my way to give everyone more than enough time to understand prospective financings that are coming down the pipeline. I usually get about a 2 to 3 months heads up. So will every local government that I'm working with. But for an example, let's say the city of Springfield charges $150 for a PACE project, but Sangamon County, and I'm not saying they're going to do this. This is again a hypothetical example. Let's say they charge $10,000 per execution of an assessment contract. As you can imagine, if they both execute within a week, the property owners are going to gravitate towards the municipality. So this is a through and through open market architecture. This is not a workforce development program. Property owners can pick their own contractors. They can pick their own lenders. We, the collective we, are simply shuffling the paperwork to facilitate these economic development projects.
Awesome. Definitely another tool in the toolbox for economic developers and to grow your community and figure out how to make a project financially feasible. Excellent.
And that's, and I was going to add, that's not to say a local government can't undertake some marketing if they want. Recall, at the end of the day, the local government owns the program. What does that mean? While IFA is undertaking the day-to-day responsibilities and IFA undertakes the financing of each of these projects, the local government always retains its prerogatives. The local government doesn't sign an assessment contract for a project. Nothing ever happens. That's somewhat the beauty of adopting the ordinance. If Effingham County adopts the ordinance tomorrow and never signs an assessment contract in the next 50 years, nothing ever happened. You're not creating a right for property owners. There's no obligation by the local government. Said another way, local government also has the freedom to market the program, hold webinars such as this, conduct events promoting CPACE. But I will say, typically local governments simply add a hyperlink to their website that links over to the IFA website. And if there is any inquiries, the local economic development staff usually just forward to my attention, and then I handle it from there. And if it's worthwhile and deserves local government's attention, I'll circle back and then we'll have a conference call.
And that was another question that did come in, the roles and responsibilities for that local government. And so you noted passing the ordinance and then working with the IFA, both have to approve and then to sign that assessment. Is there any additional responsibilities on that are to the local government?
No, and that's by design. That's very intentional. The idea here from the lender's perspective is to mitigate risk, and from the local government's perspective, mitigate obligations or responsibilities. And so IFA and its not-for-profit affiliate, which obviously has no staff, but just a board of directors and officers, we undertake all of those responsibilities. The only two responsibilities for any local government are signing the assessment contract and then signing the assignment agreement that assigns that assessment contract to IFA. I always get the question, okay, but what about foreclosure? I understand that foreclosure is an obligation, but remember, just like Courtney and I can't pick and choose what property taxes we pay, neither can property owners. They can't choose to pay the fire department and not the library district. So if a property owner is not paid a special assessment, it's the same equivalence. It's a lack of payment. So a special assessment, again, is a through and through voluntary property tax. Can't pick and choose the property taxes you pay. You either pay them all or you pay none of them. So if someone doesn't pay their special assessment, that means they haven't paid their property taxes. And very likely they haven't paid their other property taxes either, by the way, which means they're already going through the foreclosure process with the county. So it's just an additional line item. It's not an additional obligation.
Awesome. Thank you for that explanation. Maybe shift a little more towards the putting a financing package together. I think you had noted about utilizing the PACE program with traditional mortgage or financing, but then also recognize that the IFA has additional programs too, such as participation lender programs. Can the CPACE, how does it compare and contrast, or how does it interface with other programs offered by the IFA?
Yeah, somewhat complicated question, to be honest. I'll try to simplify my answer. The bread and butter financial product that my agency has undertaken the last 4 decades is the issuance of tax-exempt bonds, private activity bonds, projects that qualify for tax exemption under the federal law. That's not what CPACE is. CPACE is a product driven by state statute. For all intents and purposes, it's conventional financing. It's taxable. No one's receiving an exemption on federal income tax. So the traditional product that IFA offers, I don't foresee much interplay between tax exemption and CPACE because they're different markets. They're different buyers. They're different investors. However, where IFA is going, we will see a convergence of our products. And again, that's why we're in this game to begin with. IFA was recently designated the climate bank for the state of Illinois. So we are making dozens of applications to the federal government for various programmatic activity that's going to come by way of the Inflation Reduction Act, various other pieces of legislation that have been adopted by Congress and signed into law. Where do we envision this market going in the not too distant future is IFA having this financial product available as is, and then being able to offer additional security such as credit enhancement, debt service reserves, participation loans if there's still a gap in the financing of any particular project. And I think that's the real win-win here for local governments. It's my agency, the IFA, that is going after the federal money for our collective we benefit. So to the extent IFA can work with local governments in a collaborative effort today, I think we'll see exponential rewards for all of us in the near future.
Excellent, excellent. And glad to hear that flexibility and the willingness to work to make a project go forward. And sometimes it takes a complicated thing, and sometimes it's more simple than others, but understanding that there's tools and resources made available to the local communities, to economic development, to these potential developers to spur this private investment. And we want to definitely utilize them when they're most appropriate. I had a couple questions come in about fees, and you had noted the 50 basis points of the one-time fee, 0.5%, if you will. But 2 questions came in, and I think you could probably address them both the same. What are fees payable by the unit of local government to the IFA? And then what are fees payable by the developer to the IFA?
So none. The local government doesn't pay IFA anything. In fact, the local government doesn't pay anybody anything. The second question, I believe, was what does developers pay? Our fee is one fee. It's 50 basis points. That's a market leader, low cost leader. Again, I think I mentioned this earlier. The most analogous program is what's taking place in California. By the way, the California market is the most established market. So they're a great bellwether of PACE financing for the country. They charge 75 basis points. The counties in northeastern Illinois, their program administrators charge 1.75%. So you can understand half of 1% is a low-cost leader. It's not necessarily a developer fee. It's simply a fee paid by the property owner to IFA for IFA services. The property owners will also pay a title company. They'll also pay the fee to bond counsel. Sometimes lenders have fees for their loans, like origination fees. But importantly, this is an open market architecture. So that's all subject to negotiation outside of the purview of IFA, and furthermore, outside of the purview of the local government. That means that any property owner can pick its own transaction team, pick its own counsel, pick its own vendors, and then negotiate those fees such that it's to the liking of the property owner. That's intentional. The alternative would be to undertake a massive ongoing procurement process, which doesn't work well for any of us with the state's procurement laws. I'll happily say that as an agent of the state. But it makes sense, right? It makes sense for property owners to pick their own team, pick their own contractors, pick the people they're comfortable with. There's comfort provided by the statute in terms of bond counsel opinion. IFA, for what it's worth, is a state agency. We're not a private actor with private interests. Again, it's always a collaborative effort in terms of approval. So it's a true open market architecture for everybody, and that benefits everybody in terms of lowering the cost of these financings.
Awesome. So most certainly encourage people to shop around and put together that team of those professional services and how you want to finance this and how you want to proceed forward in the program or with your project. And this program definitely allows that flexibility to it. So great to hear. I had a question come in. When you talk about the 25% limit, is the 25%, is it that 25% of the new energy improvement project value, or 25% of the total property value, or the total project cost?
Total property value.
Total
now, the statute intentionally simply says value of the property. It doesn't say stabilized value of the property. It doesn't say, it doesn't qualify it under any sense. So in effect, lenders can choose what they're comfortable with since it's their money. Are they comfortable lending at 25% of the stabilized value in 5 years? Are they comfortable lending up to 25% of the as-is value? That is within the purview of the lenders to choose. I will say that we, IFA, are more than comfortable with looking at future stabilized value pursuant to an appraisal report. But importantly, it's items like that we'll discuss with the local government if it comes up. The standard, I'll say, is stabilized market value post-construction is more often than not what lenders will go by. Because most lenders require an appraisal, when we rewrote the PACE Act, we wanted to provide a cheaper option. So if somebody wants to use the market value as assessed by the local assessor, they can do that. But importantly, the PACE Act limits it to what offices of assessor can be utilized. So like a board of review does not qualify. We'd be happy to take up those amendments, but no one's requested thus far because more often than not, lenders require an appraisal, arm's length appraisal from a third party.
Awesome. I'm loving the questions coming in. I know we've passed the hour time frame. We'll have a hard stop at noon. If you do have any questions, please throw them in the chat. And as a reminder, a copy of the recording, this presentation will be sent out next week, and any supplementary materials as well. And Jennifer just threw a question here to maybe re-elaborate a little bit. You noted it during the presentation, some of the Q&A, but she said, so the 0.5% fee, the 50 basis points fee for the loan. So 0.5% fee is for the loan, but that's it, or is there interest too? And just noted that she missed it. There's a lot of information we're trying to digest. So just re-elaborate quickly the 50 basis points, and then note the potential interest associated to these debt.
Yeah, well, with respect to interest, that's what lenders charge for their risk. That's their income. So a lender will say, offer a $10 million loan. The lender will underwrite that loan, and the lender will charge an interest rate commensurate with such underwriting. So in effect, because this is an open market architecture, What you have is eligible properties with eligible improvements, and they will have lenders competing to get the business, meaning you're driving a lower interest rate environment, kind of like sharks in the water, if you will, when they smell blood. So that benefits the property owners. So that's just finance 101. Number two is there are multiple parties in any given bond transaction, note transaction, conduit debt transaction, pick your term of art. Those parties are typically paid by fees. IFA is one party to this transaction. We provide our services for a fee. Our fee is not ongoing, it's not annual, it's just one time at closing. Our fee is half of 1%, 50 basis points of the loan amount. That is a low cost leader in comparison to all other PACE programs in the country. That's intentional. We are trying to scale the program, not trying to make a lot of money off of this, if you will. Without local governments establishing the program, there are no potential project activity. So interest rate is always a product of the macro interest rate environment. The Federal Reserve has, I think, undertaken 10 interest rate hikes in just the last year alone. Most recently, their last policy meeting, they paused the federal fund rate increases. I typically see lenders benchmark these interest rate terms off the 10-year treasury, and then they add a spread. There's no rule of thumb for that. It's simply the market standard. That's based on what I see come across my desk. All lenders have their own cost of capital. All lenders underwrite differently. All lenders have different comfort with risk. And accordingly, all lenders will have a different interest rate that they offer to property owners. It's up for the property owners to determine what the best interest rate for them is in an open market. Did that address the question?
I think so, definitely.
Okay, thanks.
And she said yes, so good, an exclamation point.
Okay,
so
okay.
Excellent job.
All right, thanks.
Very, very interesting question that came in, and just denoting sometimes with these projects, especially when you work with a project that maybe DCO has to offer, that you have to get approval of these programs prior to actually initiating the project and having any expenditures, capital expenditures. What if a project is underway that has made improvements that qualify but has not applied for CPACE? Can they still apply?
Yeah, so refinance, that was another tenet of why we rewrote the PACE Act in 2019 to give the market comfort that if these improvements have already been installed or are currently under construction, they can be refinanced through CPACE, and that is in fact accurate. The PACE Act allows for refinancing. In fact, some lenders will prefer refinancing. Borrowers will prefer to refinance as PACE special assessment because their construction loans, they'd prefer to draw money as needed. So to take a very simple example, you have a $100 million construction project. The property owner doesn't want $100 million on the day the deal closes. They have to start paying interest on $100 million. If it's a 2-year construction project, they'd probably rather have $25 million every 6 months or some other tranche staged financing. So typically construction projects are done through stages and tranches. It doesn't lend itself well to the issuance of bonds or notes unless you do drawdowns, which are a logistic nightmare. We do have that capability. We were going to do a drawdown project, but I should caution, that was going to be for a $120 million project in downtown Chicago. So there was economies of scale there that made it worthwhile. More often than not, PACE lenders will go back up to 2 or 3 years. Each lender is different, how long they're willing to go back and refi a particular project. Under the statute and under the program, as long as there's remaining useful life on an asset, it qualifies. It's typically the lenders that won't look back more than 2 or 3 years to refinance an eligible improvement. And that's for all lenders.
Awesome. You had noted just a couple more questions and we'll probably wrap them up. If you have any last minute questions, through in the chat. We do have one more in the chat. And I had one that was sent to me a little earlier too. You had noted the appetite for this type of financing is typically a million plus, and noted that projects that are income producing properties such as a hotel or maybe a multifamily property, and even throw the example in there of the industrial one for the industrialized greenhouse. But is there a minimum amount of financing required to do this, or is it simply the appetite of what the open market is?
Simply the appetite. And what I will say to my fellow economic development finance professionals here in the state of Illinois, if I'm on a private phone call with a lender and I ask the lender what their minimum project size is that gets them out of bed today, in today's interest rate environment, they'll tell me $2 million. A year ago, it was $1 million before the interest rate environment went up. If I then say, okay, thanks for telling me, can I publish it on my website? Then every single lender will then say, we'll do anything up above 250,000 or 300,000. What I am telling my fellow professionals and colleagues today, where the market is about $1.5, $2 million. I think the smallest project I've done was right around 1.5. That kind of gives you an idea of the institutional element of this financial product. It's not necessarily a retail banking product. I think everyone strives to get to the corner grocery store type project, if you will, the $50,000 projects, the $100,000 projects, myself included. The best way to get there is through a standardized market, standardized protocols, standardized procedures, something that everyone understands, something that everyone plays by the same rules. We are trying to achieve that through the establishment of the IFA PACE program throughout the state. And furthermore, within our current existing documents, lenders had the capability to warehouse assessments. Now we're getting a little nuanced in terms of real estate finance. But lenders can warehouse multiple financings before they go out to issuance of long-term debt. And it's that type of aggregation. You take a bunch of smaller projects, package them together, and then issue a long-term bond secured by the various special assessment contracts is where you really get economies of scale. Of course, the question is why? Well, it's because typically transaction participants have minimum fees, right? So bond counsels will have minimum fees. Originators, as we mentioned, they'll have minimums like $1.5 million, $2 million to get out of bed. Appraisers, you have minimum fees. Energy auditors have minimum fees. And so when you have smaller projects, the statute, given its prescriptive elements of comfort, can be a little expensive. And so the way to attack that expense is to aggregate deals, beat or exceed those thresholds for minimum fees, and then you get economies of scale. And that's something I'm proud to say the IFA offers that nobody else can offer because we are a statewide finance agency.
Awesome. So appropriate fit, and most certainly a little sweat equity tied into it to see if it is an appropriate fit for the project, but right. Definitely an appetite to try to do these programs as well. Well, and you noted a lot about lenders there, and great job in detailing that. But you'd also earlier showed a list of the approved capital providers. If there is a lender that is on this webinar today, or might be listening to the recording sometime in the future, how do they go about to be an approved capital provider if they're not already on your list?
Sorry, my earphones. Can you hear me, Courtney?
I can hear you just fine.
Sorry about that. My AirPods died. Yeah, so please contact me. My contact information is in the chat bar. Our website, ifapace.com. You can find my contact information there as well. Our board of directors, and by our, I mean the Illinois Finance Authority Board of Directors, we meet the second Tuesday of every month where we approve projects and approve lenders. So it's really a simple application process. I send some boilerplate documents to the lender. As long as they're in the commercial real estate lending market with an authorized officer that's been in the market, or the bank itself's been in the market, lending market, not PACE market, lending market, they qualify. At the end of the day, lenders are lenders. They understand what they're doing. The statute's quite prescriptive in terms of what's eligible and what's not. And even if a lender is unsure, they have the subject matter expertise of the authority to assist them. They have bond counsel that delivers an opinion to provide that comfort. But I always tell lenders, if the paperwork to become an approved lender of the authority takes you longer than 15 minutes, you're doing it wrong. Yeah. So that should provide some comfort on the call today that we've kept it as about as simple as possible.
I like it. Keep it simple, most certainly.
Yeah.
Shelley had a question here, and Shelley, maybe elaborate a little more if needed. But if a business receives a grant towards the portion of the project, how does that affect that 25% is what you put in there? So I'm assuming this is like a grant towards a clean energy project or renewable energy, and how does that potentially play with the involvement of PACE financing?
I think it would be fine. I would look at that as a cash equity infusion. If anything, you're improving the operational wherewithal of the business within those four walls.
We love grants, most certainly. And we're nearing the hard stop. We've got just a few minutes left. I think I'll ask just one more question. Brad, you did an excellent job in detailing all this, a wealth of information, most certainly, and something I'm going to review and go through. I've got a bunch of chicken scratches and hit my notes and just constantly learn from you. And you've detailed so much walking us through your presentation, but then also in this Q&A. And heartfelt thank you for that. But if somebody is interested in this, we've talked about everything, but if somebody is interested in the PACE program through the IFA or CPACE financing as a whole, where do they start?
By emailing or calling me, and then I'll provide the overview. I'll walk them through the various drafts, and then come up with a path forward. That's the responsibility of IFA, my agency, and quite frankly myself. That's what I do 10 hours a day, 5 days a week. And that's because we've developed the subject matter expertise by rewriting the law, by being in the fixed income market for so long. And by the way, we've also worked with local governments through the World Bond Bank, for decades. So this kind of fits right in our wheelhouse. We're really good at this. I'm proud to say, somewhat humbly bragging here, excuse me. But it's always a collaborative effort. We provide a day-to-day operational expertise. If there's something that's actually eligible, something that looks viable, is probably a better word, the local government will be the first to know. I try to be very good at communicating future eligibility, future viability, potential projects. I almost always have the local government at least a month heads up. Hey, I got something here. There's a lender interested. So this will never be like a shock or surprise. I'll never call you on Tuesday and say I need stuff by Wednesday. It's not the way I do business, and it's not the way I'd expect any local government to do business either.
Awesome. Most certainly concur with you. Good communication up front and good communication throughout a project is definitely needed, and that's how you secure that public-private partnership and continue to build and be successful. See in the chat, you've got Brad's contact info, bfletcher@ifa.com, or can call him at 312-589-0939. We'll get a contact page put in the slide deck that we send out as well, and we'll include that contact information in the follow-up email following this. Again, Brad, a heartfelt thank you for educating us today and really dissecting something that is a little bit of a complicated topic or subject for something that is new, and that is definitely another tool in the economic tool belt, if you will. If you're interested in CPACE financing or the IFA PACE program or anything else that the IFA may offer, do contact Brad, or as always, contact one of the Business Navigator Alliance of South Central Southeastern Illinois. You see the contact information on your screen. Would like to invite everybody to our next webinar for July. We're shooting for the 27th, the last Thursday of the month, and actually working towards trying to do a live stream of an event that's going to be hosted by Coals Together, where Brian Wacker of the Cook Group will be presenting on the Illinois Paid Leave for All Works Act. So very interested, looking forward to that one. We hope that everybody had a good time today. We hope that you found this as a very informative and educational webinar, and that all your questions towards PACE financing, throw it to Brad. We'll try to help you wherever possible. But again, Brad, thank you for educating us today. Thank you for guiding us through this webinar. I hope everybody has a good rest of the day. Thank you.